Okay, what's going on, guys? We're back. We're doing the second video for the PowerPoint here. We're picking it up, talking about financial accounting, right? Let's talk a little bit about an auditor, right? What is an auditor? They essentially review the financial statements of a company and make sure that they conform with GAAP. They give an opinion on those. So if you go into practice, right, when you graduate, you're kind of fundamental fork in the road is going to be, do you want to go into public accounting or do you want to go into private industry? And what we mean by that, typically with a public accounting firm, it's like a CPA firm. And with that, right, it serves the general public, right? So anybody off the street can come in, right, any business, and you provide services to them. Typically, the big service lines are like audit and tax. In distinction, private industry might be like where you work for just a single company, right? I am working for Google, right? I do the books and records for Google. That's my only client. When you're in a CPA firm, right, you have a bunch of different clients. Hey, we're doing the audit for Sheets. We are doing the audit for the car dealership, right? So we have a bunch of different clients that we're serving. Different work-life balance in those areas, right? If you go into public accounting, there's going to be a busy season. There's going to be stress, pressure. There's definitely going to be kind of advice and things like that. You should get your CPA on there. Bigger raises in public accounting, right? Depends on what firm you're at, but I've seen raises anywhere from like 6, 7, 8% up to one year I saw somebody get a 15% raise. They tend to do that in your earlier years in practice, whereas in private industry, you typically might get like a 2 or 3% raise. So there's good and bad, right? Private industry, you're probably looking at more of like a 40-hour work week. Public accounting, it could be, during a busy season, 60, 70 hours. So, a very common path is to start in public accounting and then flip over to private industry. But anyway you go, right? All accounting is good accounting. But that's a personal decision that you're going to have to make at some point. Likewise, if you want to do the CPA exam, that's like a big thing that you need to decide. And I always tell people, if somebody says, I want to be a CPA, I'm happy they do that. If somebody else says, hey, that's not really for me, I'm not really interested in doing the CPA, I'm equally as happy for that. Because the thing is with the CPA, you really have to want to do that because it's such a grueling exam. And it's not for everybody. And I know plenty of people who are accountants in practice and have a good life and have good work-life balance who aren't CPAs. In any event, right, when we talk about an auditor, right, you'd be working at that public accounting firm, you're considered an external auditor, right? So if we have, I don't know, like McDonald's, right, you would come and look at their books and records and express an opinion on those records. That's different from an internal auditor, right? An internal auditor works internal to a business, right? So you might be an internal auditor in McDonald's and provide basically like an assurance type role or some type of check and balance in the business. But generally, when you talk about an auditor, it means an external auditor. We care about auditors, among other things, because there's been a lot of accounting scandals, right? The big one is Enron, right? Happened like pretty much a quarter of a century ago, but its effects have been very great. Among other things, post Enron, right? We now have SOX, the Sarbanes-Oxley Act, which provides more strict and stringent standards related to accounting and auditing. And specifically, what happened with Enron? It was kind of a pump and dump scheme, right? You had the CEO, the CFO of Enron, more or less providing like fictitious financial statements that would make the stock go up, right? And then you would have Arthur Andersen, their public accounting firm, right? So right now it's the big four, like if you want to go into public accounting, right? It's like Deloitte, PwC, KPMG, Ernst & Young. It used to be the big five, right? Arthur Andersen was the fifth one. Post Enron, it just collapsed, right? There was too big of a scandal for it to have credibility. But essentially, right, they did like a pump and dump scheme and their CPA didn't catch it. A lot of people in the general public lost a lot of money because they had invested in Enron, and a lot of people lost their jobs who worked at Arthur Andersen. When we talk about, accounting standards, right, there's really kind of two like overarching themes, right? It's kind of like if you ever look at the Constitution, should we look at it literally every single word matters, like it needs to be written out? Or is it more of just like a framework and a suggestion? Are we looking kind of the spirit of the Constitution? Similar things here in accounting, right? When we make accounting-based rules, right, some of them are going to be very delineated, right? You must do A, B, C, D, E, very, very kind of technical. Others are going to rely more on principle-based. We have certain outcomes that we're trying to achieve or avoid, right? Like fraud, for example, and we rely on the profession to kind of make their best judgment in there. Overall, right, if we had to look at like GAAP versus IFRS, GAAP tends to be more rule-based, where IFRS tends to be more principles-based, but there can be a mix in each of those. In those situations, right, where we have to rely on our professional judgment, presuppose some type of ethical standards, right? We got to do the right thing. We want to be good accountants. We know that we have an impact on society. If you're in practice, right, it's pretty likely that you're going to be part of a professional organization, right? So when I was at Deloitte on day one, I had to sign up to be a member of the AICPA. And as such, right, I was subject to their code of ethics. So there will be specific ethics that you're subject to, but in GAAP, right, there are situations where it's just relying on professional judgment. In those cases, right, there's a little framework here for how to be ethical. You can read through that. Don't memorize it. You could look at this MCQ there. So the overall idea with it is we want to be efficient, effective, and ethical accountants. When we look at the kind of overarching framework with GAAP, right, we have the conceptual framework, right? It's kind of like the accounting constitution, right? So like in the US, we have a constitution. The goal is to have like freedom and all these other kind of things. Here with GAAP, we have the conceptual framework, which has goals, right? The main goal is going to be to provide useful information. So if we were to kind of map this out, right, we have our like overarching goal, and then we have all these other inputs that go into it. If we start with the primary objective, right, we talked about this, right, it's to provide useful information, right? In order for information to be useful, right, if that's the main goal, it has to have certain characteristics, and there are constraints that we're subject to, right? So for information to be useful, right, it needs to be both relevant and faithfully represented. You need both. If you have one without the other, it's not useful. What it's an example of when something is relevant, but it's not faithfully represented? I don't know. Let's just say that we report revenues of $1 million, but it's a total lie, right? That would be relevant. Investors, the third parties, care about it, but it's not faithfully represented. What's something that's faithfully represented but not relevant? I don't know. Maybe we have a account receivable balance of 3 pennies, right? It's accurate, it's reported correctly, but it's not going to rise to the level of being relevant. Look, 3 pennies isn't going to make or break if I invest in this company, right? So in order for decision usefulness, the end goal, we need it to be relevant and faithfully represented. We have kind of characteristics or subcomponents of that, right? So relevant information has predictive value, confirmatory value, materiality, right? It's material, we care about it. Faithful representation, it has to be complete, right? We need all the information there. It's neutral, it's not biased in any way, and there's no errors on there. On top of that, right, we also have kind of other things that enhance this end goal, right? So we want overall, for information to be useful, it has to be comparable, right? I need to be able to pick up one set of financial statements and compare it with another. It has to be verifiable, right? If you say that the cash balance is X, I better be able to somehow trace that. It has to be timely, right? If I am making my investment decisions in 2 weeks from now and you only get me the financials a month from now, it wasn't timely. And then it needs to be understandable, right? When you give me these things, I need to be able to pick it up and make sense of what is going on. Overarching all of this is kind of a cost-benefit constraint, right? Yes, we do want to provide useful information, but there is a limit as to how much money we're going to spend on that. In other words, if it costs like $3 million to look at one account balance that's worth $2,000, the benefit isn't going to outweigh the cost there. So yes, we will try our best. We will be reasonable, but we're not going to spend unlimited money to get to this end goal. It has to have essentially the benefit outweigh the costs. So here's some good MCQs, right? Which of the following is not a component of relevance, right? So we're looking at this relevance, right? We have predictive, confirmatory, materiality. Oh, free from error is not one of those. Which of the following is not a component of faithful representation? Right now we're looking over here, complete, neutral, free from error. Complete, neutral, free from error. Understandability is not. That's an enhancing characteristic. So I would be familiar with that chart. When we have the financial statements, right, it really boils down to the elements, right? In the same way where we have like the human body and then it goes down to the cell and the atom and all that stuff and the microbes. I'm not a scientist here. I haven't taken biology since like 9th or 10th grade. But it boils down to like the very fundamental level. We have a similar thing here, right? If we boil down those financial statements to the fundamental level, right, we have a variety of different elements on there. You can look at the more kind of formal definitions down there. Because this is chapter 1, I'm just going to keep it high level, right? We have our assets, which are kind of like what we own, our liabilities, which are what we owe, our equity, the difference between those two, investments by owners and distributions to owners, comprehensive income, which we'll talk about in future chapters. It's kind of like net income plus or minus a little bit more. It's a broader picture. Revenues and expenses, and then gains and losses, right? We'll talk about these more in the income statement chapter, but like what's the difference between a revenue and a gain? A lot of times it comes down to like, is this associated with the fundamental reason we're a business, right? If we're a pizza company and we sell pizzas, that would be a revenue. If we're a pizza company but we make money in the stock market, that might be a gain on there. But we'll learn more about that in the income statement chapter. Underlying assumptions, right? In order to take an in real life business and put it into 4 financial statements, we're making certain assumptions, right? The economic entity assumptions, right? This presumes that events can be identified specifically with an economic entity. The going concern assumption, hey, we assume that this business is going to just continually operate into the future. There's no kind of signs that there's going to be a bankruptcy or things that it would go away. The periodicity assumption basically says, hey, this business in real life, when it runs, it doesn't like magically stop at the end of the quarter or the end of the year. We just assume that we can kind of put these stop signs and roadblocks in and produce financial statements for those time periods. And then likewise, we assume that money, right, is going to be the best kind of valuation and way to represent the economic items going on. Okay, so those are some assumptions. Let's talk a little bit about recognition, measurement, and disclosure. Right, recognition tells us when we book the journal entry, right? So for example, when you would credit a revenue is whenever you earn that revenue. When you would debit an expense is generally when you incur that expense. Measurement in distinction tells us how much, right? What number are we going to put in there? Disclosure, right? We need to make sure that we have appropriate disclosures at the end of the financial statements. Basically anything that a reasonable third-party investor would want to know about, we have to include. So we're talking a little bit about GAAP, right? We said revenues are whenever they're generally going to be earned. Right? What is it? It's an inflow of an asset or a settlement of a liability resulting from providing a product or service to a customer. Typically, you think about it as the sales of the business, right? Again, it's whenever it's earned, and more specifically, whenever it's certain that we're going to collect it. They either give us the cash or it's going to be an account receivable. And there's really two types or two ways that we can make revenue, right? Any business, it's either providing a good or a service, right? So if you go to the mall or Amazon, you buy something, you're getting a good. Here, right, if you're paying to be in college, I'm providing a service, I'm teaching. If you pay a roofer, if you pay a painter, right, they're providing a service. On the flip side, we have the expense recognition principle. And generally, right, we're going to debit our expenses when we incur them. And when we say the word incur, right, we kind of have a framework here for different situations, right? You can go down and look at these, but it could be like cause and effect, right? Like if we sell something, then we would do, right, like debit cost of goods sold. So if then type thing. Associating with the revenues with a specific time period, it could be something like, as they have down there, like salaries of workers they work during this month, we're going to take the expense during this month. Systematic and rational, right, that could be depreciation, right? When we buy a building, we don't immediately expense that building up front. Instead, we spread the cost over the useful life as we use the building. Finally, here in the period incurred, right, these are kind of one-off things, but it could be something like, advertising. We incur the advertising here. We'll take the expense. Overall, right, GAAP uses a mixed attribute model, which basically says this, right? As a general rule, if you pick up the financial statements, you look at, for example, the balance sheet, it's going to be historical cost, what you paid for those items. There are, however, exceptions to when we depart from historical costs. In other words, we would use like net realizable value, current cost, present value, fair value, right? So that's kind of what this is saying, right? So historical cost, that's going to be the general rule, right? It's what you paid for the item, right? The amount given or received in exchange in the transaction. So you can look at that there. We do depart from that, right? There are exceptions. Net realizable value, right? What you can sell it for minus any selling costs, current costs, right? Present value, right? So if you remember from like bonds, for example, you would shrink those down to their present value. The bonds, also like net realizable value, these other items you remember maybe from your 101 class, like inventory, lower of cost and market, so on and so forth. Fair value, right? What it's currently worth on there. We'll talk a little bit about fair value in this class in later chapters with equity investments. And when we're looking at fair value, right, what something is worth, it's a little bit speculative, right? I bought a house one time, I thought it was worth X, they thought it was worth Y. You would get an independent appraisal to come in, right, and value the house, and they would use different kind of approaches or techniques, right? We could look to the market, right? What are nearby houses going for? We could look to the income approach, right? If we were building a building or buying a machine, how much income is this going to help us generate? The cost approach, right? If we were to literally just build this thing and, make it, what would it cost? So that's what it's saying here, right? Which of the following is not a measurement attribute, right? Well, we've seen these kind of historical cost, NRV, and fair value, the general rule and the exceptions. List price, we're not going to use. Fair value hierarchy, right? Kind of from best to worst, right? If we're looking at, and we're trying to figure out what this thing is worth, quoted market prices in active markets is the best, right? So it might be like, hey, what is Google stock worth? Well, if we have another share of Google stock that's in the general stock market, that's very easy to find out. Outside of that, right, if it's not observable, right, as we go down, the more kind of subjective it becomes, okay? So let's look at an MCQ here. Which of the following is not true? That's just a way of saying which of the following is false. 3 are preferred to 2. No, right, it goes from best to worst. 3 would not be preferred to 2. Finally, right, a couple, remaining slides here, the fair value options. So for certain types of assets and liabilities, not everything, but we will see, specified financial assets and liabilities, you are allowed to record them at their fair value. We'll talk about more of that in, the last half of the class when we look at equity securities. We did mention a little bit about footnotes, right? We have this full disclosure principle that basically means, hey, anything a reasonable third party would want to know about our company, we need to put in those financial statements. If they pick it up and they're saying, hey, how did you calculate depreciation? Or what do you mean by that account? It's kind of ambiguous. We need to disclose or talk about those things in the footnotes, okay? You can look at that slide there. GAAP is always changing, right? Historically, we used a revenue and expense approach where, in other words, we would emphasize revenues and expenses with some assets and liabilities recognized as necessary to make the balance sheet reconcile with the income statement, right? So historically, we kind of focused on the income statement first, the balance sheet second. More recently, right, we're moving to an asset liability approach where we kind of start with the balance sheet, look at the changes in those account values, and then we can back into the income statement at a very high level. But that's it for chapter 1. Like I said, I like to keep these videos, less than a half hour. This is just the intro chapter, right? So this is about as easy as it gets, high level refresher. So with that, we will end it here. We will see you guys either in the problems or the next chapter videos.